Now, an option contract, right? So an option contract gives us the right, but not the obligation to purchase an underlying stock. So an underlying stock is like Facebook, Etsy, whatever the underlying stock is. It
Mhm.
gives us the right to purchase an underlying stock at a certain price by a certain date. Okay. So we are just essentially predicting where a stock is going to go. We are putting a down payment on a stock. So let's just say that Facebook is at $180, right? And you think it's going to go up today. So you purchase a 185 call, which means you think Facebook's going to go to 185, past 185, or close to 185. You
Right.
just think it's going to go up, right? So you think a call option, you think the stock is going to go up. So it gives you the right, but not the obligation to purchase an underlying stock at a certain price by a certain date. Now,
Right.
let's say Facebook's at 180. You think it's going down. So you purchase a 175 put. Now you think Facebook's either going to go towards 175, to 175, or past 175.
Right.
That gives you the right to sell an underlying stock at a certain price by a certain date. So to break this down into simpler terms, let's say you have a BMW on Facebook Marketplace, right? I
Uh-huh.
call you and say, you say, I want 5,000 for this BMW. I call you and say, listen, I don't get paid until April 29th. So what I'm going to do is I'm going to send you $200 right now to hold that BMW at $5,000. Now, I might be able to come up with the funds before April 29th, but if not, if it goes past April 29th and I still don't purchase it for $5,000, you can keep my $200 and that's on. You can sell it to somebody else, right?
Right.
Now, let's say 2 days later, all the BMWs in the world blow the fuck up, right? Just some weird thing happens, except for the one you were going to purchase on Facebook. So you call that dude and you're like, hey, I got good news. My taxes just hit. I got the 5 grand. And he goes, whoa, no, bro. Didn't you hear all the BMWs blown up? This shit's worth at least 100 grand now. Well, that doesn't matter because I have an option, a contract. We have a contract stating that I can purchase it on or before April 29th for that $5,000. So you must sell me that car for $5,000 now. Does that make
Right.
sense?
Yeah.
That's what an option is, bro. You're literally just telling them you're gonna pay a certain price for that stock on or before a certain date. That's it. That's
Okay.
how contracts are valuable because if you get a 180 call on Facebook for April 29th and tomorrow Facebook goes up $10, now it's at 190. You can exercise that contract and purchase 100 shares at $180 even though it's valued at 109. We That's called using your contract. That's called executing your
Hold on.
contract.
So if you make the initial purchase on that contract and that shit shoots up in value crazy, you're even though you purchased what they say I bought one, I can add to more. I can add more buying power and add and buy more if I wanted to.
Well, the contract's going to be up in price then
Right.
because
Okay.
now the stock has went up, right? So there's two types of value to a contract. This is sum that up for you. There's two types of value to a contract. So we're going to go to Facebook real quick, right? So there's two types of value to a contract. If this shit will load. So you have intrinsic and extrinsic value, okay? There we go. View option. Oh, this is called an option chain. All right. This is called the option chain. So you have two types of value to a contract. You have intrinsic, which is the difference between the share price and the strike price. The strike price is what the share price represents. So this is what you think it's going to go to. Okay.
Right.
Now there's a value and then extrinsic value, how much time you have left on that contract, your expiration date. Those two things make up this price. So let's go to the week after since that's expired. So this and the difference between this makes up this price, right? So if Facebook is at 183.20 right now, and you buy this 190 call for $918, right? If Facebook goes up even 50 cents, that's 50 cents closer. So now you have 50 cents more intrinsic value. So now this contract might be worth $940 because you are closer to the strike price.
Right. Now I have a question. What if it doesn't go to that strike price, but you're
It
already,
doesn't. It
already
don't have
worth-
to.
Oh, so like whatever you see in profit, you can just take out.
Yep.
Okay.
So you just need it to go in your direction. That's it. You
Oh, so
don't.
that's just an aiming point, basically.
Yep. Yep. That's just an aiming point. And you want it to go past this
Right.
because the farther it goes past this, the more valuable they become.
Right.
So if I purchase this contract right now, when Facebook is at 183.20 and Facebook goes down $1, this contract might be worth only $815 then. Now, if Facebook goes up $1, it might be worth 1,000 now, and I can sell it for 1,000. Do you see what I'm
Yeah.
saying?
Yeah.
So from the second you buy in, if the stock starts going in your direction, your contract is going to start increasing in value and you can sell it real quick.
Right.
Now you have that, it doesn't have to hit that strike price whatsoever. It
Right.
just has to go in the direction. So if you purchase a call, it has to go up for you to make money. If you purchase a put, it has to go down for you to make money. That's it.
Right. Okay.
So the reason I say this is a middleman is because we only care about what this is doing. This shit don't mean nothing to us. We're just buying this because we think it's going up, or we're buying this because we think it's going down. That's it. That's all the difference is, right?
Right.
So there's no other difference. Now, the two values to it, the extrinsic and extrinsic value. Now, people say, do I have to wait till April 29th to sell it? No. You could, these go out to January 19th of 2024, right? You could purchase this contract, this 190 call for $4,300 and $4,360, and it could literally go up $10 the same day, and you could sell it even though you have almost 2 years on your expiration date.
Right.
So you don't have to wait for the expo, and you don't have to wait for the share price to get to your strike price, right?
Right.
Neither one of those. Now, this is where people always think, because I thought the same thing. Now, time is against us, right? Because each day you get closer to the expiration date, that lowers your odds of the stock going in your direction, right?
Right.
So every single day you lose, your contract loses extrinsic value because you are one day closer to the strike price. So as long as your intrinsic value is going in your direction and it's covering your extrinsic value, you will still be profitable, right?
Right.
So let's say the share price is at 183.20. You purchase that 190 call for $918. Let's say the stock goes up and down, up and down, up and down all day long, but then at the end of the day, it ends at 183.20. You are still going to be down money because you just lost a whole day of extrinsic value.
Right.
So your contract's still going to be negative. So don't think, oh, I bought in when Facebook was at 183.20. So if it's down 50 cents. So if it goes back to 183.20, I'm going to be even. That's not the case at all. Now you might need it to go to 184 for you to be even. Do you see what I'm saying?
Right.
Because every single day you lose value. So that's those three key things right there, bro, is literally like the most important things you needed to know, because that would have been the most trickiest for you if you didn't understand this and you bought a contract. Because I did it. I used to watch the stock and be like, well, I bought in at $93. It's at $92. I'm down $100. But if it goes back to 93, I'm going to be even. Mind you, it's like 3 days later.
Right.
Like, I didn't know that I kept losing money every single day. So
Damn.
that's why they're risky, bro, because they lose value. This right here is $918 and the stock price is still $7 away. The only reason this is $918 is because you have a week left. Because look what they were worth today, $1.
Damn.
So you're paying over $900 in extrinsic value.
So I got a question though. So when you buy it, if you say you buying it for a put, I mean for a call, and say the closer, and you say you're like you bought it at the 183 price, and your aim is for 190 or higher, but say it never moves past 183, and it doesn't have no movement the whole time. So the whole time it has no movement to the end of your contract, you're losing value on that contract.
Every day. Yep.
So what is it like? Will it like drop in money? Like if you'll see the
Fuck,
price.
this bitch would go to zero.
Dang.
Because on expiration date, this contract's gonna be worth nothing. It goes all the way to zero.
But long as it's somewhat profit, then I'm good.
Yeah, so when you purchase a contract, you need it to just go in your direction. If the stock starts consolidating and it doesn't move, then you're going to lose money. Now, the closer you get to your expiration, the riskier it's going to be to hold it because you're losing. Each day you get closer to your expiration, you lose more money aggressively. So the closer you get, like right now, I'm going to show you this, but right now you lose $85 a day. Tomorrow, this is going to say 95. The next day, it's going to say 110. The next day, it's going to say 120 until eventually this is bigger than this number. So it makes it go all the way to zero.
Mm.
So every single day, it gets more aggressive. You lose more and more money.
And even if you're holding it and you're in profit, each day you're still losing.
Yeah, you're still going down. So let's say, all right, so I see what you're saying. Let's say we buy Facebook at 183 and it goes up to 186 and you're up $1,000, right? But then it stays at 186. Now the next day it might only be up 900. And then the next day it might only be up 800. Next day it might only be up 600.
So that's why you scout, because you try to get in and out with your
Well,
profit.
I'm just a day trader because I don't hold contracts overnight because we don't know what's going to happen pre-market. And if that motherfucker drops down $5, you're going to be sick as fuck because you're like, I was up $400 at close yesterday. The stock is down $6 pre-market, meaning you can't sell during that time. Contracts you can't trade during pre-market. So, and you can't see how much you're down. It only the contract's value only fluctuates from 9:30 to 4. After that, it goes on hold until the stock market opens at 9:30. But the stock market actually opens before 9:30, where you can actually trade shares, stocks. So it's fluctuating. So let's say you buy in, you're up $400. Stock was up $1.30 yesterday, and now you get on and you look and that bitch is down $4. You're gonna be like, oh my god, I'm gonna be down like 60% as soon as it opens. I should have fucking took profits.
Right.
You can't control what's going to happen the next day, so therefore I've gotten burnt way too many times. That's why I don't hold contracts overnight.
That's how I can tell. Like a lot of my questions is gonna go towards you, and I'll probably just follow because that's what I always wanted to have that this in and out. Like my homie, he holds it for us. I hate swing trading. I hate that shit.
Bro, I can't do it. I can't weather the storm, bro. I can't weather the storm.
He'll do it though. I could give him that. I watched him clear 6, 7, 8 bands, but his strategy works for him. But he don't know how to explain it. Like you can explain shit. That's why I signed up for your course and stepped away from that shit. But I can't do it. It's too much anxiety. My mind go crazy. I like to go in and out. I like to get my money, get in and out, and be content with that, and not be greedy and just be humble with that money and start to the next day.
Bro, what I do is I get in, I hit my targets, I'll trim some of my positions. So I'll buy 10 contracts, I'll be up 50%, I'll sell 6 contracts, and I'll hold 4, and I'll set them to automatically sell at break even. So then if the stock keeps going up, I'll keep trimming. If it starts to go back down, the rest of the contracts I have will automatically sell for what I bought in with, and the trade's over regardless.
Okay.
So that's what's nice about contracts. You can have them to automatically sell. You can have trailing stop losses, everything. So as the stock's going up, it automatically puts it 10% higher. So like, let's say that you're up 50% and you set it to sell for a trailing stop for 10% below whatever it's up. So if it's up 50%, it's going to sell it automatically 40. If it goes up to 60%, now it's going to automatically sell at 50, and so on and so forth. So therefore, you can let that bitch run without watching it. And then if it does happen to keep going, you keep making money. If it turns around, it automatically sells regardless for you. So you don't got to keep watching the shit. That's what's nice about contracts is you can buy it and put that shit in your pocket and set an alarm. and that alarm goes off, boom, contract sells you on to the next trade. So
Yep.
I do that because I'm terrible at watching the chart. Cause I'll be on the 5 minute and I'll see a red candle and I'll be like, damn, what's it doing on the 1 minute? I'll look at the 1 minute and I'll see like 6 red candles and I'll go sell that bitch. And that motherfucker turns around, takes off. You know what I mean? It was
Right.
just a pullback.
Right.
Bro, I can't get my emotions out of trades, bro. So that's why I trade quickly in and out, because it's hard. If I look at that contract and I see I'm down money, I'm gonna sell the bitch, bro. That's just how I am. And then it turns around. Here's what's crazy, bro. Contracts fluctuate so much that you can be in a trade. Say you buy this contract for $900. The stock
Right.
goes down $4, right? Let's say your contract's down 60%. The next day, stock goes up $10. Now you're up 120%.
Right.
Bro, I've had a contract go down to where all the way down to 98%. And then I still sold it for 212% gain 3 days later.
Damn.
And mind you, I was a little over 6,500 deep. So I was down like 6,200 on a $6,500 trade. And I said, you know what? It's only got 300 left. I'm going to just hold this shit till the wheels fall off. Fuck it now. And then that bitch went up and I made like almost 8,000 off that trade 3 days later.
See, yep.
So, but I can't do that with swing trading, bro. I can't weather the storm. The only time I can weather the storm is if it's already down like 80%. What's the point of selling? I might as well just hold this bitch, see what happens now.
Right. See, but the only thing I learned about swing traders, that's why a lot of them, they mark their shits on larger time frames, because they already are anticipating a pullback to manipulate the traders that lose money. And when they manipulate that pullback, see, that's the only thing I'm confident in, because I watched my homie do it so many times. That's why I think he marks his charts up on a later time frame. So when that pullback happens, it's got to happen because it's called market structure. The market has to have a pullback. And that's when that shit, niggas will get emotional and get their money out the chart, and really it's still going to shoot the same way they already thought it was going to go.
Yep, that's how I be trading. So do you think you understand contracts and how they move? Now we're about to go inside of contracts, like all this shit right here and what's important and what's not.
Yeah, not.
But do you think you understand contracts now? You're not confused on them. You know why we buy them. How?
Yeah, you broke that shit down simple as hell. Like, I understand.
Yeah. So inside this contract, right? So you're probably already familiar with the spread, right?
Yeah.
The bid and the ask. So it's the same thing with a contract. You got the bid and the ask. 910 is the bid. 925 is the ask. So what do? We meet them in the middle for a limit order, right? Now, you know that a limit order does not need to get filled. If you put a limit order in and this bitch goes up $1, this shit's not going to get filled because you have it set at 918 and it's worth 919 now. So therefore, this shit, 919, 920, 922, 945, you go back on your phone, you think you got filled, you go back and you're like, damn, I should be up like 40%. You look and you find out your order never got filled because that bitch went up $1, bro. I've been there. Dude, I lost 13 racks. I lost out on 13 racks on a trade because of a fucking dollar. You know what I mean? So it's limit orders are good. I mean, you always want to limit in. You know what I mean? You don't want to pay for the market price because you could be potentially paying $20, $30, $40 more expensive than what it's valued at. You know what I mean? And if you're buying 10 contracts, that's $300. You buying 20 contracts, that's $600. You know what I mean?
Right.
So your position size is what matters when you market or limit in, because if you're only buying one contract, then who cares? You're only paying $5 or $10 more. But if you're buying 10, 20, 50, 100 contracts, you could be paying $1,000 more on this trade than you're supposed to be. Right. So I always limit in unless the bid and the ask is like $5 away, bro. So if the ask is 923 and the bid is 926, I'm just marketing. I'm not even playing with a limit order. I'm just marketing the fuck in, getting the trade over with. Now, at first, you're going to mark it in for a little bit, get the feel for it, stuff like that. You know what I mean? So limit in. So you just limit in, shit like that. Now, when you limit in, now you're going to be trading on Webull, and I'm going to send you a video because you're probably going to be on your phone a lot. So I'm going to send you a video of the phone version of me going over how to purchase a contract, how to view the option chain, all that shit on Webull, right? So
Okay.
you'll have that. You can just watch that clip. It'll break it down. It'll show you how to put in stop limits. It'll show you how to put in all that shit. So whenever you go over that, when you put a limit order in, it's going to take you, as soon as you hit submit on Webull, it's going to take you to another page where it's going to say 0/ however many contracts you're buying. So if you're buying 5, it'll say 0/5. If it says 0/5, that means your order didn't get filled yet. If it says 3/5, that means 3 of your contracts got filled, but not the other 2. You need that shit to fill all of your contracts, right? Or you might have to hit modify order, and now you were just going to pay 196. Now that bitch says 201. So now you got to modify your limit price, put it at 201 and resubmit the order. You know what I mean?
So hold on. So if them shits all ain't filled in, you can't cash out your money.
If the order never filled, you never owned the contract.
Oh, okay.
Because you're personally buying these contracts off of other people. That's why I
Right.
try to tell people, if you're winning, bro, remember somebody else is losing. Literally, we're not playing against the government. We're not playing against a stock company like Forex. We are literally, if you are winning, me or somebody else is losing, bro. So somebody else that's trading options right along with you is taking that hit that you're gaining, or vice versa. We don't create wealth, bro. We spread wealth. That's all option traders do. We just spread wealth through the winners and losers. That's it.
Right.
We don't actually create wealth. Without us, option trading wouldn't exist, because all we're doing is gambling. We're saying, oh, well, I think it's going to go up. And he says, oh, well, I think it's going to go down. Okay, well, I'll sell you a call. Okay, well, you sell me a put. You know what I mean?
Yeah.
That's what it is, bro. We're battling each other. That's all we're doing. Retail traders are battling each other. So with options, we got the bid and the spread, right? So the bid and the ask, limit order, you buy in the middle, right? That's the mark. Now you got the high and the low. The low is how low the contract went today. The high is how high the contract. So this contract went to 900 and it went up to 1300. Now the previous close is what the contract closed at yesterday. So if we were doing class last night, this would say 1210 right now. But
Right.
today it says 918. So yesterday this contract was worth, at 4 o'clock when market closed, this contract stopped at $1,210. Today at market close, this contract stopped at $918. So if you
Right.
would have bought this contract today, you would be down today, or you'd be down right now.
Right.
Now the volume is how many people bought this contract today, right? Or so volume is how many bought this contract today. Now, mind you, this is the 190 call. The 187 call is completely different. It's going to have different numbers. It's going to have a different high. It's going to have a different low. It's going to have a different volume, because it is an entirely different contract. It has a different strike price with a different intrinsic and extrinsic value. You know what I mean?
Right.
So this 185 is not the same as this 190. These are all different and they move different. All right.
Right.
Now, open interest. Open interest can be used as a tool pre-market. Open interest is how many people have this contract open from the day before. So Monday morning at 9 a.m. pre-market, this open interest is going to change. And it is going to tell us how many of these 4,000 people still have this contract open, meaning they bought it and they held it overnight.
Right.
Now, the reason you can use open interest as a tool in the morning is, let's say you're looking at Facebook that just did a $10 run. Contracts are up 300%, right? You're looking at it and you see the volume is 16,000 people. And then the next morning you see open interest is 13,000 people. You're going to be like, wait, what? This contract's up 300% and 13,000 people still holding this motherfucker? They think it's
Right.
going to keep going. You see what I'm
Right.
saying? So you can try to figure out who's holding what, how many people, where everybody's heads are at. Does that make sense?
Right. Right.
So you can use that pre-market as a tool. Now, that's not something I do, but it is something that I tell my students, because I want you guys to be able to find your own way as well. You know what I mean? Little
Right.
things that I try to just break everything down as simple as possible. And then at the end, I tell you what I do, what I use, and just go from there. You know what I mean?
Right.
Now, the next is implied volatility, bro. I can't stand implied volatility. It's our fucking enemy. Implied volatility is how much the contract is overvalued. So this due to the demand of the stock, right? So when a stock is in high demand or no demand, just high volume period, right? The high IV or the IV is going to increase, which is going to increase the price of the contract.
Right.
So this contract should not be $918. This contract should literally be like $400 or $500, but it has 115% IV. So let's say you buy this contract right now with this IV this high, right? And let's say the demand for the stock starts dropping. Well, your IV is going to start dropping. Well,
Right.
therefore, the value of your contract is going to start dropping. So you could literally be in a trade. The stock could be going in your direction and you could still be losing money because the IV is dropping too fast.
Damn.
It happens. So you don't want to hold contracts overnight with high IV because the next morning is when the implied volatility drops or goes up rapidly. Now, I have also been in, so you don't want to play meme stocks, bro. Stay the fuck away from meme stocks. They always have high IV. They are always, they're lottery plays, bro. Yes, I did make like $80,000-$90,000 on GameStop and AMC and shit, but I also lost probably majority of all of it playing them over and over again, because when you consistently keep hitting and you consistently keep winning, what do you think you do? You keep fucking playing, bro. It's like blackjack. You don't fucking stop.
Right.
So they're lottery plays, bro. They're lotteries. If somebody's like, oh, AMC is going to rip, it's going to rip, it's going to rip. Why is it going to rip? Oh, because everybody's telling you it's going to rip? Yeah, so therefore it's a lottery. Nobody fucking knows if it's going to rip. We're just hoping that we can get enough people to buy it so it does rip. So we're going to spread the word.
Right.
You know what I mean? That's what a meme stock is, bro. Just don't play with them. What you're going to do is you're going to find a stock that you enjoy that moves $5 to $10 or could move potentially $5 to $10. And you're going to consistently play the ups and downs of that stock. Buy a call, it goes up, sell the call, buy a put. It goes down, sell the put, buy a call, it goes up, sell the put, so on and so forth on the same stock over and over and over again. I play Facebook, Etsy, NVIDIA, Microsoft, and Crowd every fucking day. I either play one of those five. And you probably see it. You probably see me in the Discord. That's all you ever see. Facebook, Etsy, Crowd, NVIDIA, or
okay. So you don't really touch Tesla like that, do you?
I love Tesla, bro, but Tesla is fucking wild, dude. You could
So
literally.
how does that dude crack Tesla like that?
He's been playing Tesla for like 9 months. That's the only stock he plays. He don't play nothing else. And that's like me with Facebook or Etsy or NVIDIA or Crowd, bro. I never fucking lose on those stocks. I always hit 100, 200 percenters back to back to back. I never fucking lose because we play them so much that you start to learn it like a song, bro. It's easy. It's easy to identify when it's going to turn around. It's easy to identify when it's going to reverse. When you play a stock for a year straight, staring at the same fucking stock chart, the same candles over and over again, bro, you could be on I could go to jail tomorrow and call you from the jail phone, and I guarantee you I could fucking play Tesla and Etsy through the goddamn jail phone, bro. You could tell me what it's doing and I could play it.
Damn.
Literally, dude. I literally did that when I went to jail. I don't know, it was months ago, back last year when I went to jail. I had the Discord, Ian Fields. We have tablets in jail now. I messaged Ian. Ian messaged me on the tablet. It was 9 o'clock. He said, yo, he told me the levels of all the stocks and where the previous highs or lows were. And I sent him back a watch list so he could put it out in the server. Nobody even knew I was in jail, bro. I swear to God.
Damn.
Bro, he was posting plays that I was telling him to take while in jail on the jail phone tablet. I swear to God. I swear to God.
Damn.
Bro, like 10 people knew about it in the Discord. Other than that, nobody to this day still doesn't know that I went to jail.
Damn.
Like, bro, I don't.
That's crazy. Damn, that's how you know, like that shit. You really in tune. Like the better put yourself in that position, be in jail, and it's still called treason. That's crazy.
Yeah, bro, and you could get to the same. Brad could do it too with Tesla, bro. He did. He was in the trader chat and he's like, "Hey, I'm not watching my phone, but I just read the message above that Tesla just broke 1066. I would, if I was you, I'd buy the 1030 put, because if it doesn't break through 1070, it's gonna fall. It hit 1070 and immediately reversed. Guess where it bounced off of? 1030, bro. On the fucking money. It hit 1030.02 and shot back up.
Damn.
It made a $30 drop and reversed again, bro. Like, it's just playing the same stocks over and over again. You know what I mean?
Right.
So you want to stay away from contracts that have high IV. Now, high IV is for holding, for swing trading, for buying it
So
today, selling it tomorrow.
what's considered high IV? Like what percentage is
80,
high?
85, 90, right around in that area.
So basically
85, 90.
anything 70% is the go-to.
Eh, honestly, IV is not going to affect you buying a contract. IV is going to affect you holding a contract. Does that make
Okay.
sense?
Yeah.
Look at this, bro. It was just watch this. 3 months ago. Bro, look at these spikes. 116, 162, 1618, 148. Look at these fucking swings, bro. These are $60. If you would have bought a contract here February 23rd and held it till March 2nd, that contract probably was up, I would say, at least 5,000%. At least. And that's just an average guess. And then immediately bought a put the same day you sold the call. Within a week later, you could have made another 12,000% on the way down. Like,
That's crazy.
It's just stupid, dude. Look at today. So right here, we have this low at this open at 101 pre-market. That would have been my entry for a put. I would have waited for the retest, and that would have been my entry. So it would have pushed up. I would have waited for it to break this pre-market high. It pushed down. As soon as market opened, it pushed up, but immediately failed. As soon as I seen that fail, I would have been waiting for it to hold this bottom. If it didn't hold this bottom, it pushed back up. I would have been like, okay, well, if it breaks this high, I'm going to enter for a call. If it breaks this low, I'm entering for a put. And bam, right there would have been my put entry. When it pushed up and it tested off of that, that would have been my average down. Boom. And I would have caught that all the way down.
Damn.
But I didn't trade today. It was Friday. I had shit to do. I wasn't even worried about it. So now inside the contracts, I mean, this is down $4, right? All the stocks are pretty much down $4 today, which is weird. They're down like 30. So look at these contracts. Look, 140%, 114%, stuff like that. They just run, right? So if we look at this contract, this put, let's look at the April 29th put. So you see how it went from 500 to 560. That's it.
Yeah.
Or call. Sorry, I was on the wrong one. There's the puts. So this put went from 299 to 425.
Right.
That's about an average trade. So about $125 per contract on a contract that costs about 150 to 250. That's an average trade, bro. So that's about 50, 60%. That's an average trade. So these are
so in that situation, would it have been like the profit for off one contract? That'd have been like $125.
Yep.
So then, okay, and I see what you're saying when it comes to the buying power. You got the buying power. That's when you would make what you.
Yep.
Okay.
Now you got to also think. I buy that bitch at 299. I would have bought 10 of them, right? So immediate for three bands. Now, as soon as it went up to about, I would say just an estimated guess where my trim would be. What? I would say on average, I probably would have trimmed that at like 330. So I probably would have sold some at 330 for a $30 gain on each contract. So I probably would have sold 5. So there would have been 150 profit, right?
Yeah.
Now, mind you, off a $3,000 entry. So
Right.
there would have been $150. Boom. And then I would have probably waited till it hit about 375 and I would have sold 2 more. Boom. So there would have been another 150. So there I'd be up 300 now. So I'd have been up 10%.
Right.
And then I would have held the left or the other 2 for the runners for 425, which would have made me 250. So that would have been about a 5. I would have made about 465 to about 550. So I'd have made about a 25% gain off that, because you have to pay yourself out, bro. You can't buy in at 300 and expect to always sell at the high, bro. It doesn't work that way. You're going to be paying yourself out as it goes up.
Right. Okay.
Because you're going to have your trims. You know what I mean?
Yeah.
So it's the same as Forex. I mean, you don't buy in and then wait until it gets to the very tip top and then you sell. It just doesn't work that way. You have to take profits on the way up. It's the only way you're a consistent bull trader or
Right.
consistent profits. If you try to get the high every time, how the fuck did you know that 425 was going to be the high? You know what I
Right.
mean?
Yeah.
Because I guarantee you it was at 299, then it went to 330, then it went back to 310, and then it went back to 350, then it went back to 310, and then 360, 330. So why didn't you sell at 350 or back to 330? If it went from 310 to 350, back to 310, back to 330, back to 310, you probably would have sold at 310 then, because you were
Right.
thinking, okay, well, now we're having trouble here. So do you see what I'm saying? So you
Yeah.
have to pay yourself out because contracts fluctuate so much. I bet you that contract went from 299 to 425 probably 15 times today
Right.
and in between there. You know what I mean? So bouncing around. So you just have to pay yourself out. That's what I try to tell everybody, bro. They think like this shit's a Hail Mary where you can't trade Forex and see 1,000% gain. You just can't. It's not possible. You
Right.
can't trade stocks and see 1,000% gain. It's not possible. The
Right.
only thing in this world that you can trade and see 1,000% gain on a regular basis is options, bro. Nothing is more lucrative than options, but you need the buying power. This ain't crypto where you buy in at fucking 30 cents and you sell it for 40 cents.
Right.
This is shit where you're paying $100, $200, $300 a contract and selling it $500, $600, $700.
Right.
So the money's there. It just take, bro. Your first goal is to get your account to 25,000. That's your first goal. So
Yeah.
here's what you look, right? So let's say you started with $2,500. If you start with $2,500, it's probably going to take you, because you're going to have your ups and downs. You're going to be up one day, down the next. You know how it is.
Yeah.
Your ups and downs. You're probably going to take 3 to 4 months if you're trading responsibly and not just YOLO in your account. If you're trading responsibly, it's probably going to take you about 3 to 4 months to get to 10 racks, right?
Right.
Now, from 10 racks to 25 racks, it's probably going to take you about 2 to 3 months. Now, from 25 racks to 50 racks, it's probably going to take you about a month to 2 months. Now, from 50 to 100, you can do that in a month or less.
Right.
Because you see what I'm saying? So everybody looks at this. When I tell them that when I'm teaching, they're like, what? Well, dude, what? I'm like, bro, I've been doing this for 15 months. I did my fucking slow grinding. Brad's been doing it for 15 months. He did his slow grind. We are just now starting to post big profits, bro. Literally, this year we just started. Brad wasn't posting anything more than $2,000 gains until honestly, I just seen his first big gain in January, and he's
Right.
been trading since February last year. So
Right.
like, that's what people don't understand, bro. They don't know that it takes the grind. Now, if you have 5, 10 bands to start with, fucking throw it in. You're probably making $1,000 a day, 1,500 this day.
Now I'm not even gonna lie. I ain't gonna lie. I got some money saved up because I did like little side shit, which is like, you know, I read between the lines. But I bought my first investment property for 25 grand on my dad, on my stepdad. I'm renovating that house right now. What I was gonna do is work. That's why I did I got a plan. I got a 3-day work schedule, and I'm gonna do this as much as I can, studying and asking questions with you. And I'm renovating the crib. I'm pulling equity from it. My house is valued at 140 grand on the high end. I might get maybe like 80, 90, or 100,000 at 80% because I'm redoing a new roof. I'm doing everything. I'm taking that money that I pull with the money I already have saved when it's left over. And once I'm done, I told my uncle I dumped 40 or 50 grand in there immediately. But I'm gonna
Listen, your
I'm gonna,
account's bro.
I'm gonna take the time to actually learn everything. So I'm
And
not
practice,
risking.
bro.
Yeah.
Practice.
Yeah.
I'm going to teach you how to paper trade. You're going to be, bro, if you do this right and you practice and you build your confidence and you take paper to small paper trades accounts to big amounts over the next like 2 or 3 months, and then you put 50,000 in a fucking account, bro, that 50,000, bro, sky's the limit, bro. I guarantee you're going to be literally seeing 100% return monthly, bro. If you do this right, I promise you.
All right. Yeah, that's where I'm at with it. That's why I ain't take my time because I told
Because
originally.
that fuck all you, bro. You don't need a margin. You don't need a cash account. You don't need a Webull account. Go straight to TOS. We'll get you right on TOS. I didn't know you had that type of funds. Most people don't got that fund.
Yeah, my uncle, he a co-sign for it too. I just wait because what I was going to do, I got my CDL. I was gonna buy me a semi truck for like 80, 90 grand cash, borrowing against the crib, and then use my 40 bands, that 40, 50 bands I already got saved from my side shit that I had to like for like a maintenance account. But I said, you know what, bro, I don't want to go through all this. It's too much gas. It feels the wrong time to get into the truck industry. I said, what can I do? My uncle's like, listen, I'm doing this to the stocks. Here's my homie. I looked at the shoes, seen your shit. Like, all right, I'm just gonna do the same plan I have for the truck industry and just do it for the stock market. And that's it.
Yeah, bro. Listen, if you're gonna start with it, because you gotta get your first goal is 25,000, so you can get off of a cash account, and get to a margin account, right? So you
Yeah.
can be because you under 25,000, if you're on a margin account, you can't day trade more than 3 day trades a week because it's called a PDT rule. But
Right.
if you have more than 25,000, that rule doesn't apply to you. So you can buy and sell all fucking day long. You never have to stop. And as soon as you sell it, the funds are settled immediately. So you can buy with them again and keep selling back to back to back to back to back. There is no breaks in between.
Right.
So
Okay.
bro, your scalping mentality, you're gonna be dumping like 10 bands into you're probably gonna buy at least 10. You're gonna buy probably at least 10 to 25 contracts, no matter how much they cost, all the way up to $500. So sometimes you're gonna be putting fucking $5, $6, $7, $8,000 in each trades, but you're gonna be seeing 25, $3,000, $4,000 scalps within fucking, bro. I literally see sometimes I'll get in, I'll put 8K into a trade. 15 minutes later, I'm at 23,000 profit.
Right.
15 minutes later. So that's where you're going to be at, bro. Your money's going to grow. You do this shit right, bro, you're going to be a millionaire. I promise you. I promise you. You do this
Yeah.
shit right, you be a millionaire in no time. I give it
That's
2 years, your account has $1 million in it.
that's what I'm saying. That's why I just want to learn everything, man. Like I really just want to. I just want to learn everything. Take my time and just grind this shit up. I know it's gonna be worth it. That's the only reason why. Like my uncle, the reason why he got me on to this day. Like I told you, my main goal was to do the trucking. Once I seen everything that was going on, how this was, I was like, yeah, this is it.
And you see, bro, listen, it's physically impossible for this shit not, bro. I have over 1,000 reviews, bro. Like, bro, everybody talks highly of this shit. You know what I mean? Because I
Right.
teach correctly, bro. I've been doing this for so long. I know the best way. Like, as soon as you tell me what you're familiar with, I already map out the class. So, like,
Right.
if you weren't familiar with TA and support and resistance, our next class would be different. But our next class is going to be now indicators instead of charts and support. You see what I'm saying? I already map out classes to fit each person's knowledge.
Right.
So that's how it is. Now, the last two things we're going to go over is these Greeks right here, bro. The only two Greeks that are important are delta or theta. These are your intrinsic and your extrinsic value right here. So delta, you read it straight across like it's money. But with this, you read it straight across like it's money, but you don't put the change. Like this is $395. With
Right.
this, you put the change. So this is $42.81.
Okay.
Now, or you could say whichever's easier, always move the decimal 2 space over and then read it like it's money. So move this decimal 2 spaces over, read it like it's money. But I just look at it and just see 42.81. That's just how I see it.
Right. So why is that like that? Why? What's the difference between that? Why is it? Why is that like that?
Because delta is how much your contract, this is your intrinsic value, right? So this doesn't represent 100 shares. This represents one contract. This represents 100 shares.
Okay.
So this is representing this contract. So delta is how much your contract is going to increase or decrease for every dollar that the stock moves.
Right.
So now, mind you, after each dollar, delta will go up a little bit more, just like each day theta will increase because it's 1 day closer to the expiration date. Each dollar that it goes in your direction, delta will go up. Each
Right.
dollar it goes away from your direction, delta will go down.
Right.
So if this stock is at $97 and we purchase this contract for $395, if Etsy goes up to $98.70, our contract will go up $42.81.
Right. Okay.
Now, if Etsy goes down $1, our contract will go down $42.81.
Okay.
Now, each time it goes down, this will decrease. Each time it goes up, it will increase, right? So the farther you go away from the share price, the lower delta is going to be. Now, the reason the lower delta is going to be
So I got a question. So what's the difference from the implied what's the difference from the implied volatility? How you say that?
implied volatility.
Your volatility and the delta.
So implied volatility is how much the actual stock is in demand, and the market makers that make up the price of the contract, you know, the big shots, the fucking companies,
Right.
they decide what the implied volatility is at due to a bunch of fucking mathematical problems. I don't fucking know how to calculate it. It would probably take you months to even figure out the formula. You know what I mean? We don't know how the fuck that shit works.
Okay.
But so implied volatility is just the demand of the stock, and that can fluctuate. That can make the contract's price go up and down as well. But the nitty gritty, the intrinsic and extrinsic value are your delta and your theta.
Okay.
So the two values that make up the contract are your delta and your theta. So with delta, you want to keep delta over 0.3, right? On mid cap stocks, okay?
Okay.
On any low stocks. Now, all right, so let me reword this. So remember, you'll have this recorded too. So you want to keep delta over 0.3 at all times. Or I mean,
Okay.
0.2 at all times. You never go below 0.2, okay?
Okay.
But your ideal is to keep it 0.3 and above. Now, if you are right over top of the share price, I'm talking right fucking here on a call, meaning you think it's going to go up, and you pick, it's at 970.70 and you pick the 98 call. If the delta is 0.2, purchase it. I mean, you can't get any more better unless you go below the share price, but why are you going to go below when you think it's going up anyway? You're going to pay more than what you need to.
Right.
So you want to keep delta over 0.3 as much as you possibly can. If you can, or if you need to, you can go below to 0.2, but never go below 0.2. Now, if it is a low cap stock and 0.06 and 0.16 are the only two deltas you can purchase the biggest delta that is above the share price. Now, we have in the money and out of the money contracts, okay? In the money is when the share price has already passed the strike price.
Okay.
Out of the money is the opposite way. So on a call, you want to purchase anything above the share price, out of the money. So you want to purchase anything out of the money. On a put, it's the opposite way. You want to purchase anything below the share price because this is considered out of the money because you think the stock is going down. So a put, purchase above, a call, a put, purchase below, a call, purchase above.
So you purchase, so you purchase above what, like for like
the share price, whatever the share price is.
So
on a
if
call.
so is that, oh, so you mean like when you, like for the 99, the 100, like whatever you see for the strike price, that's what you choose above it for.
Yep. So whatever. So if this is at 97, you would get the 98, 99, or 100 for a call. If it's a put, you would get the 97, 96, or 95.
Okay.
You see what I'm saying?
Yep.
So now, what everybody, oh yeah, one more thing. Theta, this is how much you're going to lose today. This is your time value. So this contract lost $33.62 today, but you gain $50.27 per dollar. Now, there's going to be times where if you're playing weeklies, meaning the expiration date is the same week, which is the only contracts I play because they're the cheapest. I don't care about time because I want to sell today anyway. So why am I going to buy a longer expiration date if I'm selling it today anyway?
Right. Okay.
So delta is going to be less than theta some days. So this might say 30 and this might say 80. Now, what I do is I take delta and I divide it by 10. So therefore I can try to fit, or I divide it by 7. So therefore I know how much I'm generally losing each hour. So therefore I know how much.
Why 7? Is that why? Because of the days?
Yeah, because all right, so here's the weird thing about Theta, and I actually just figured this out 2 fucking days ago. Can you believe that? This is how much I don't care about shit. I just focus on what the stock's going up or down. I actually figured out that Theta doesn't stop. I thought it was 9:30 till 3 or 4, meaning that it lost that. Well, actually, Theta does not stop. You consistently lose money overnight. So in the morning, as soon as the stock market opens, if the stock opens at the exact same price and your contract's going to be down a little bit because you lost some Theta overnight. I
Right.
didn't know that. And the reason they do this is because you would literally just purchase contracts at 3:59 p.m. 1 minute before the stock market closed, and then you would just try to predict the move for pre-market. So therefore, you wouldn't be losing any value in your time.
Right.
So they can't do that. So it's not fair. So they have to make it so that's not possible. So I just found out the other day that Theta actually gets taken off at the middle of the night as well. And I didn't
Okay.
know that.
Okay.
So if you want to research that, listen, I've been trading options for 14 months and it hasn't affected my judgment now. So if you want to research more into that, that's completely up to you.
Okay.
But that's just, I mean, Theta is how much you lose through the whole day, right? So you look at Delta.
So is that so Theta? So when you said about, remember how you said like daily, no matter if you don't like however long you hold that contract to your expiration date, regardless if you're in profit or not, you lose money every day. That's Theta. That's
Yep.
okay.
Yep.
So what about the Delta? What is that? Because now I understand what Theta is from earlier when you
Delta
explained
is
about.
your intrinsic value, the
Okay.
difference between your share price and your strike price. So the closer it gets to your strike price, the more money you make, the more delta it's going to be. Delta is how much your contract increases or decreases for every dollar that the stock moves.
Okay.
So delta is your extra. Now remember, you keep delta over 0.3, never below 0.2, unless there is
When
no
you say
out.
when you say keep it over the 0.3, what you mean like with an entry or when you're holding when you're actually in a trade?
No, when you're entering. So
Okay.
to pick the right contract, right? Because that's probably your guess right here. How do you know which contract to pick, right?
Yeah.
So that's what I mean. Because the farther you go away, the lower delta is going to get. So if we go out here to this 106, delta's 27. We go out here to this 110 call. Yes, it's only $96, but delta's only $17. See what I mean?
Right. So
So
I mean
as
that at that $17, you wouldn't technically enter that trade in, right?
I wouldn't purchase that contract, I would buy a different one.
I mean, yeah, that contract. Okay.
You want to stay. So here's the key. You want to stay as close as you possibly can to the share price, but above it on a call. And on a put, you want to stay as close as you possibly can to the share price, but below it, right? Because you think it's
Okay.
going down, call, you think it's going up. So what Delta will do is if you get in a little squirrely and you're like, oh, well, I want to, all right, well, I'm going to get this 109 call because I think Etsy's going to go up to 109. This will keep you in check because you need to be closer to the share price in order for Delta to be higher. See what I mean?
Yeah.
So the farthest you could go away on this call would be 105 for $200. That would be the farthest strike price you could go away.
So Delta can get as high as the share price or above.
No, yeah, look, Delta will keep increasing all the way up to $100.
Okay.
It won't go any higher than $100 though. You will
That's
not find
so
one.
basically. So your goal is when you enter a trade, you will shoot for the one that's the closest to the share price for Delta.
Yes.
Okay.
Well, not only that, because if the stock starts going the wrong way, if the farther you're away, the harder it is to come back. You see what I'm saying?
Yeah.
So if we pick this at $97 and we pick this 110 call and that stock goes down $2 more, now instead of now we were already $13 away. Now we're $15 away because on expiration date, you're going to need, if you have to hold this contract to expiration date, you are going to need this share price to pass your strike price for you to make any money.
Right.
On expiration date. So therefore, it lowers your risk if you buy closest to the share price.
Okay.
So I usually like to stay right in this area, right in 3 to 4 at most, right in this area. And I like to go with even ones. So like usually when the stock's this low, they'll go up by $1, but when you're higher, like with Facebook, they go up by 5s. So I only ever go 3 away because that's 15 fucking dollars. So like with Facebook, 185, 190, 195. You see what I'm saying? That's
Yeah.
about the farthest I'm gonna go away right here. Maybe 200, but let's look. So can we go to 200? We can, but that's cutting it close.
Right.
You see what I'm saying?
So what is that? What would it, for what about that 190? Click on that 190. What's the delta for that? Like,
45.
so would you get in that technically?
Yes.
But but this right like one thing I think I'm trying to grasp for that delta part because I don't want to overthink at the same time. I know that shit comes.
You're way overthinking it.
Okay.
I already know you are. Listen, delta is just how much your contract is going to go up or down from the time you enter if the stock share goes up $1 or down $1.
Okay.
So from the time you enter, whatever that delta is, so this contract here, let's watch this. This stock is at 183. We
Right.
buy this 190 call at $98, right?
Yeah.
Or $980. We have a 45 delta. Now, the stock goes up $1. We make $45. Our contract will increase by $45.
Okay.
If it goes down away from our strike price because we have a call, we are going to lose $45. So delta is just how much the contract is going to go up if the stock goes up $1 on a call, or is it going to go down? If
So
the
that
stock,
and that's a winner like you that's a loss or gain on every
Yes.
dollar at that price.
yes.
Okay. All right. I understand. I'm sorry. I understand. All right.
So you just want to keep delta over 0.3 and never go below 0.2. Now, when picking a contract, it should take you 10 fucking seconds, bro. Literally 10 seconds. I'm going to do one for you, and this is what I'm looking for, and this is what you should be looking for, okay? We're going to
Okay.
go to Snapchat. Oh, Snapchat's at 29.75. We think Snapchat's going to go up. So already in my head, Snapchat is at 29.75. So in my head, I'm going to be looking at the 30, the 31, the 32, maybe the 33 at most. We click into Snapchat. We go out to our expiration. Immediately, we come straight to the share price. Boom, the 30, I click it, delta's at 49, it's only $126 purchase. I'm not even gonna look at the rest. It's only $126 and I got a $50 delta. Fuck yeah, purchase, done, on to the next.
Okay.
See what I'm saying?
Yeah. Yep.
Now let's see if a stock's gonna go down, right? So here's Twitter. We think Twitter's gonna go down. Twitter's at $48. It just had a nice run today. We think it's gonna go down. So what's already in my head? 48. 47, 46, right? Boom, come straight to it. Go to the next week's expiration, obviously, because it's not this week's. Come straight to it, click put, right? Boom, the 48.50 is 275. So I said the 48 is at 250. I'm going to click on it. Delta's at 41. So I already know I can go to the 47.50. Delta's at 39. The 47. Delta is at 36, and that is only $2 away, and it's only $200. Purchase, done. See how I just did that?
Yeah.
On to the next one. We're not too far away. You see what I mean? 3, 4 at most.
Right.
That's simple, bro. You think the stock's going down? Grab a put. You think the stock's going up? Grab a call. Stay as close as you can to the share price. Keep delta over 0.3. You're perfect. You're golden. That's it.
Yeah.
Once you purchase that contract, stock starts going up, sell the contract, make a couple dollars.
Yep. Yep. I understand now. You made it simple now. I get it.
That's it, bro. That's all she wrote.
Damn.
And-
So I did all that.